Welcome to the deep dive. Today we're going to be jumping into the markets, looking at the past week and what's ahead.
That's right. And we're using a specific Market Outlook blog post as our guide. It covers the week of Juneteenth through the 16th, 2025.
And our goal here, our mission really, is to unpack what that source material says, the key economic news, the market moves it highlights.
Exactly. To give you a clear, concise picture of what happened and maybe what's coming up, all based on this particular analysis.
Yeah, the post itself says it's trying to give you those, essential news items and trends, useful for understanding market dynamics, maybe for prepping for something or just staying informed.
Okay, so let's get into it. What does this source material focus on from last week, that Juneteenth to 16th period?
Well, first up, something that sounds pretty positive from the source's view. Inflation data. Seems like good news for the markets generally.
Yeah, that seems to be the takeaway. The main point is that both CPI, the Consumer Price Index, and PPI, the Producer Price Index, they came in lower than expected.
Lower than expected. How much lower?
Well, the post highlights CPI was just 0.1% for the month. The expectation was closer to 0.2%, and that's also down from the prior month.
Okay, 0.1 versus 0.2 expected, and PPI.
Same story there. Also 0.1%, again, versus a 0.2% forecast. And that's quite a change from the previous month's reading, which was actually negative 0.5%.
Wow, okay. So seeing those key inflation numbers come in softer like that, the source definitely frames that as a market positive.
Right. It suggests maybe price pressures aren't building quite as quickly, which could ease some worries about what the Federal Reserve might do next with interest rates.
Makes sense.
The post does add a bit of nuance, though. The year-over-year CPI number for May, it did tick up a little, 2.4% from 2.3% in April.
Ah, okay. But was that expected?
Yes. Critically, that small rise was actually right in line with expectations. So the surprise was really in that monthly figure being lower.
Got it. The source also mentioned something about tariffs, didn't it?
It did. It noted there's, quote, little evidence yet that recent tariffs are hitting consumer prices.
But economists still think it's coming.
That's what the source says, yes. They expect an impact later on.
Okay. So beyond inflation numbers, the source also pointed to consumers feeling a bit better.
Yes, exactly. That University of Michigan Consumer Sentiment Report from Friday.
Oh, yeah, that was quite a jump, wasn't it? The source flagged it as much stronger than expected, 60.5%, I think.
That's the number. And the forecast was way down at 53.6%, plus the prior reading was 52.2%, so a significant leap.
And the source said something inside that report was even more encouraging.
Right. It specifically calls out the drop in consumer inflation expectations. That number fell quite a bit, from 6.6% down to 5.1%.
That is a big move. And like the source says, it suggests people are starting to feel, well, maybe less worried about prices just keep climbing and climbing. It's a psychological thing.
Definitely. We also got a bit on trade last week, according to this analysis, an update on the U.S. and China trade deal.
What specifics did it mention?
It pointed to resolution on a couple of things. Rare earth exports from China, and also allowing Chinese students back into U.S. universities.
Okay. And did it mention the tariff levels involved in those talks?
Yes, it provided the figure cited. Tariffs on Chinese goods noted at 55%, and tariffs on U.S. goods going into China at 10%.
Yeah.
Just presented factually in the post.
Okay. So we've got this backdrop, cooling inflation, happier consumers. How did the markets actually, react last week? The source said U.S. stocks were mixed, but slightly positive overall.
Yeah, mixed but tilted positive for the week. There was definitely some volatility in there, though.
Right, like Friday's sell-off.
Exactly. The report links that directly to the military strikes between Israel and Iran. Geopolitics hitting sentiment hard.
But then things calmed down a bit.
Yeah, markets recovered pretty well on Monday as that conflict went to cool off, at least for the moment.
And commodities, sounds like they were moving.
Oh, definitely. Oil prices, according to the analysis, had a huge jump Friday. Hit their highest level since way back in February 11th.
And that lines up perfectly with those geopolitical flares-ups on Friday.
Absolutely. The report notes oil is now up, 28% since its recent low back on May 5th, though it did pull back a bit on Monday with the broader market recovery.
Okay. And gold, also sensitive to that kind of risk.
Yep. Gold hit a new high on Friday, too, up 1.8%. The source explicitly ties this to those rising Middle East geopolitical risks, and it notes gold had a really strong year overall, up 29% year-to-date.
Okay, one last piece from last week. Bonds and interest rates. The source said bonds were up for the week. Why was that?
Yeah, mostly driven by those inflation reports we talked about earlier. That lower CPI and PPI data midweek really sparked a bond rally Wednesday and Thursday.
But they gave some back on Friday and Monday.
Right, kind of moved with the risk-on, risk-off sentiment swings tied to the geopolitical news. The 10-year Treasury yield, the key benchmark, ended up falling 3 basis points for the whole week. It closed at 4.45% on Monday.
Okay, so that's a pretty thorough recap of last week based on the source. Now, what does it point to for this week? What should we be watching?
Well, there are a couple of important data points coming up. Tuesday, June 17th, we get the retail sales report.
And the source has a take on that one.
It does. It actually expects the main headline number might look negative, but...
Because of cars.
Exactly. Because of the usual volatility in auto sales figures, the Post predicts that if you exclude autos, the number should actually be positive for the month.
Okay, so look beneath the surface there. But that's not the main event this week, is it? The source highlights something bigger on Wednesday.
Absolutely. Wednesday is all about the Federal Reserve. Their monetary policy meeting concludes, and we get the policy statement. That's what everyone will be focused on.
And what specific things does the source say to watch for from the Fed?
2 key things, really. First, the Fed's updated plot graph. That's where the members show their individual forecasts for interest rates going forward. It gives you a sense of their collective thinking on rate cuts for 2025.
Right, the dot plot. And the second thing...
Chair Powell's press conference later that afternoon. That's where he'll add the color commentary and explain the committee's reasoning.
So the plot gives the data, Powell gives the story. What's the market thinking heading into this meeting? Any sense from the source on rate cut expectations?
Yeah, the outlook mentioned that expectations hadn't really changed from the prior week. As of when the post was written, the market was pricing in about a 76% chance for a total rate cut of 50 basis points, that's 0.5% or less, for the rest of 2025.
76% chance for 50 basis points or less. Okay, that's a specific number the source is citing.
That was the key figure, yeah.
All right, so we've unpacked last week the better inflation news, the stronger consumer mood, the geopolitical jolts to oil and gold, and we've looked ahead to retail sales and especially the big Fed meeting this week with that market expectation for cuts. How does the source kind of help us tie all this together? What's the connection for you, the listener?
Well, it's really about seeing how these pieces interact. Last week's good news on inflation, plus consumers feeling better and expecting less inflation ahead, that creates a slightly more positive economic backdrop. It could potentially influence the Fed's thinking or how they talk this week.
Gives them maybe a little more breathing room?
Perhaps, though the plot graph itself will be the clearest signal of their intentions. And it also really underscores, like we saw with oil and gold, how global events, things totally separate from economic data, can just sideswipe markets or have really specific big impacts.
Yeah, it's not just one thing driving everything, it's layers.
Exactly. And tracking these specific data points, like the CPI miss or consumer sentiment shifts, or even that 76% probability priced by the market for rate cuts, that's how participants, from this source's viewpoint, try to figure out the puzzle. They try to anticipate what might happen next, what the risks are. It's about reading these signals. Markets trying to balance some encouraging signs on the home front against those outside risks and the big question mark over central bank policy.